Technical Analysis of the Financial Markets by John Murphy. This book is an absolute must-read if you want to understand the principles of technical analysis and how to use them to navigate the markets like a pro. From chart patterns to oscillators, Murphy breaks down complex concepts and equips you with the tools you need to make informed trading decisions. So, if you're ready to level up your trading game, make sure to like this video, share it with your fellow traders, and subscribe for more in-depth insights on technical analysis and trading strategies. Let's jump right in. Philosophy of technical analysis. Now, if you're new to this, you might be wondering, what makes technical analysis so special? Let me break it down for you in a way that really sticks. So, at the heart of technical analysis, it's all about price movements and market behavior. Unlike fundamental analysis, which focuses on things like a company's earnings or economic reports, technical analysis looks at one thing, the price. And this price movement, it tells us everything we need to know about where the market might go next. Murphy lays out 3 core principles to help us understand how it all works. First, he talks about market action discounts everything. What does that mean? Well, it means that all information, good or bad, gets baked right into the price. The market is a reflection of everything that's out there. News, rumors, data, you name it. So when you look at a price chart, you're basically seeing everything that's already happened, and you don't need to worry about diving into all the other details. Price action is the most important. Second, Murphy explains prices move in trends. And here's the thing. Markets don't move in random zigzags. Instead, they follow trends. Whether the market is going up, down, or sideways, recognizing these trends early on can help you make better decisions. The golden rule? The trend is your friend. Ride that trend as long as it keeps going in your favor, and don't try to fight it. And the third principle is probably the most fascinating one. History repeats itself. Believe it or not, the way traders react to certain situations doesn't change much over time. People have been buying and selling based on emotions for ages. Fear, greed, excitement, panic. These emotional reactions create patterns. And guess what? Those patterns repeat. This is where it gets really cool. By studying past market behavior, you can predict future price movements. It's like using a playbook of human nature. Now, comparing technical analysis to fundamental analysis, here's the deal. Fundamental analysis looks at a company's health, earnings, and economic conditions, while technical analysis is laser-focused on price action. If you're more of a long-term investor, fundamental analysis might be your thing. But if you're looking to trade on short-term trends, technical analysis gives you the tools you need to read the market's movements in real time. So, what makes technical analysis so powerful? It's all about being able to react to the market quickly. Whether you're day trading or managing longer-term positions, the ability to read and understand price trends allows you to make more confident decisions. It's like having a map that helps you navigate through the market's ups and downs. Dow theory. Where did all this technical analysis stuff actually come from? This chapter answers that. It takes us back to the early 20th century and introduces Charles Dow, the creator of the Dow Jones Industrial Average, who laid down the foundational principles that form the basis of Dow theory. Dow theory is all about understanding market trends, and Murphy explains it in a way that's super relatable. Dow discovered that the stock market doesn't just go up or down in a straight line. It moves in waves, and these waves follow a pattern that can be understood and predicted. Let's break it down. First, primary trends. This is the big picture. Dow theory says that markets have 3 types of primary trends. 1, the uptrend. This is the period when prices are moving higher. The market is showing strength, and investors are generally optimistic. It's the period when you see that bull market taking off. 2, the downtrend. This is when prices are falling. It's the bear market phase where pessimism rules, and the market takes a dip. 3, the sideways trend. Not every market is going up or down. Some markets just move sideways, with prices staying relatively stable. This is what's called a neutral trend or consolidation phase. It's like the market is taking a breather before deciding which direction to move next. Now, Murphy digs deeper into the secondary trends, which are the smaller fluctuations within the primary trend. So let's say the market is in an uptrend, but prices don't just keep climbing forever. You'll notice some pullbacks or corrections along the way. These secondary trends are shorter-term movements, but they're still crucial because they can signal a shift in the overall market direction. But the really interesting part of Dow theory, it's all about market phases. Every market, according to Dow, goes through three main phases. 1. The accumulation phase. This is when smart money, like institutional investors, start quietly buying up stocks. Prices are relatively low, and the public isn't paying much attention yet. It's like the calm before the storm. 2. The public participation phase. This is when everyone else catches on. Investors start jumping in as the trend becomes more obvious. The market is riding high, and everyone wants a piece of the action. 3. The distribution phase. Now, this is where things get interesting. The early buyers, those smart money folks, start selling off their positions to the public, who are still optimistic. The market might still look like it's going up, but it's actually starting to top out. The smart money is getting out, and the public is still piling in. Murphy does a fantastic job explaining that by understanding these phases, you can get a much better sense of where the market is at any given moment. Are we in the accumulation phase, where the smart money is quietly buying? Or are we in the distribution phase, where the market is getting ready to reverse? One key takeaway from Dow theory is the idea of confirmations. For Dow, it wasn't enough for just one index or market to move in a trend. For a trend to be confirmed, both the Dow Industrial Average and the Dow Transport Average need to show the same directional movement. This helps eliminate false signals. So, why does all this matter? Well, Dow theory provides a roadmap to the market. By understanding these trends and phases, you can better time your investments, identify major turning points, and avoid getting caught up in market reversals. In short, Dow theory gives us the tools to understand how markets move over time, recognizing both long-term trends and the smaller corrections along the way. It's like learning to read the market's heartbeat, so you can know when it's getting stronger and when it might be about to take a dip. And there you have it. Dow theory isn't just theory. It's a tool that helps you understand the market's rhythm. Keep an eye on the trends, watch for the phases, and you'll be one step ahead in navigating the market. Chart construction. This chapter is all about how we visualize price data and how those visuals give us insights into market movements. First up, you've probably seen or heard of bar charts, line charts, and candlestick charts. These are the basic building blocks of technical analysis, and knowing how to read them is crucial for understanding market trends. Let's break each of these down. Bar charts. So, what is a bar chart? It's one of the oldest and most basic chart types you'll come across. Imagine it like a vertical line showing the price range for a given time period, whether that's a minute, an hour, or a day. Each bar on the chart represents 4 key price points. 1. The open. This is the price at which the market opens for that time period. 2. The close. This is the last price at which the market traded during that period. 3. The high. This is the highest price the market reached during that time. 4. The low. This is the lowest price the market hit during the same period. If the bar is green or filled, it means the price closed higher than it opened, bullish. If it's red or hollow, it means the price closed lower than it opened, bearish. Bar charts are great for showing you the overall price movement and volatility in a clean, compact way. Line charts. Next, we have the line chart. This one's simpler and more streamlined than a bar chart. Essentially, it's a single line drawn from the closing price of one time period to the next. If you want to focus purely on the trend direction, this is a great chart type to use because it cuts out all the noise of daily price fluctuations and zooms in on where the market is moving. Line charts are great for beginners who are just starting to get into technical analysis because they clearly show the overall market direction. If the line is sloping upward, the market is in an uptrend. If it's moving downward, it's a downtrend. Candlestick charts. Now, let's talk about candlestick charts. These are the ones you'll see most often in today's trading world. Candlestick charts give us a more visual, detailed look at price action than bar charts or line charts. They're also easier to interpret because the patterns are more visually intuitive. Each candlestick represents the same information as a bar chart, but it's displayed in a more graphic way. The candlestick has a body, the wide part, and wicks, the thin lines at the top and bottom. Here's the breakdown. The body shows the range between the opening and closing price. If the closing price is higher than the opening price, the body is typically green, bullish. If the closing price is lower than the opening price, the body is red, bearish. The wick or shadow shows the highs and lows of the trading period, helping us understand the price volatility. Candlestick charts are super powerful because they not only show you the direction of price movement, but also give you a sense of how the market felt during that time. Was there a lot of buying pressure pushing prices up? Or was the market struggling, with prices fluctuating wildly? Candlestick patterns like doji, hammer, and engulfing also help us spot trend reversals or continuation signals. Interpreting price data. Now, when you look at these charts, it's important to interpret the price action. Price is not just a number, it tells you a story. For example, if the price is going up, higher highs and higher lows, you're in an uptrend. Look for opportunities to buy. If the price is going down, lower highs and lower lows, you're in a downtrend. It might be time to consider selling or shorting. If the price is stuck in a range, you're seeing sideways movement or consolidation. This is a phase where the market might be indecisive, and you could be waiting for a breakout in either direction. You'll also notice that certain patterns or shapes in the charts, whether it's a series of green candles or a particular candlestick pattern, can give you clues about what's coming next. For example, a doji candlestick often suggests indecision, meaning the market could be getting ready for a reversal. Putting it all together. The beauty of chart construction is that these charts, when combined with the right technical indicators or patterns, give you the power to predict market movements with much higher confidence. It's not just about looking at the charts, it's about understanding the psychology behind those movements. Are traders feeling optimistic, anxious, confident? Understanding these emotions through price action is key to being successful in technical analysis. And there you have it. Chart construction in a nutshell. These tools are your map to navigating the market's movements. Whether you're using a bar chart, line chart, or candlestick chart, they all help you understand what's happening with prices and give you the insight to make informed decisions. With practice, you'll get better at spotting trends, patterns, and price action that lead to profits. Basic concepts of trends. In this chapter, we're diving into some of the most important concepts that form the backbone of technical analysis. Trends, support, resistance, trend lines, and channels. Trust me, these are the tools that will help you read the market like a pro. What is a trend? At its core, a trend is simply the direction in which the price is moving. But understanding trends isn't as simple as just looking at a chart. Murphy breaks it down clearly. 1. An uptrend. This happens when the price is moving higher over time. In an uptrend, you'll notice the market is making higher highs and higher lows. It's a clear signal that buyers are in control, pushing the price up. 2. A downtrend. This is the opposite. In a downtrend, the price is moving lower over time. You'll see lower highs and lower lows. It's a sign that sellers are dominating the market, driving prices down. 3. Sideways or range-bound trend. Sometimes the market just doesn't know which direction to take. Prices move up and down within a narrow range. This is a consolidation phase, where the market is taking a breather before deciding its next move. Understanding these 3 trend types is essential because it helps you align your trades with the prevailing market direction. If the market is in an uptrend, you're looking for buying opportunities. And if it's in a downtrend, you might be considering selling or shorting. Support and resistance. Now let's talk about 2 key concepts, support and resistance. These are like invisible lines in the market where prices tend to bounce back or reverse. Let's break it down. Support. This is the price level where the market tends to find buying interest. Think of it like the floor of the market. When prices fall towards support, buyers step in, and the price tends to bounce up. It's a level where demand is strong enough to stop prices from falling further. Resistance. On the flip side, resistance is the price level where the market tends to encounter selling pressure. It's like the ceiling of the market. When prices rise towards resistance, sellers come in and the price usually reverses down. It's the level where supply overpowers demand, keeping the price from rising further. These levels of support and resistance are not static. They can shift over time. As the market moves, what was once a support level can turn into resistance and vice versa. This is why you have to keep your eyes peeled for breakouts and breakdowns. Trend lines. Next, we move on to trend lines, which are one of the simplest yet most powerful tools in technical analysis. A trend line is just a line that connects key points on a chart, showing the direction of the trend. It's like a visual representation of the market's momentum. In an uptrend, you draw a trend line below the price, connecting the lows. This helps you visualize the support level in an uptrend, showing where prices tend to bounce higher. In a downtrend, you draw a trend line above the price, connecting the highs. This helps you spot the resistance level, showing where prices tend to reverse down. Trend lines act as guides. If the price breaks above the resistance trend line in an uptrend, it could signal a continuation of the trend. Similarly, if it breaks below the support trend line in a downtrend, it could be the start of a further decline. Channels. And then we get to channels. This concept takes the idea of trend lines a step further. Channels are formed by drawing parallel lines above and below the price action. These parallel lines represent support and resistance levels that help guide price movements within a specific trend. There are two types of channels. One, ascending channel. This happens in an uptrend when prices move higher within a parallel range. The price moves between the support line, bottom, and the resistance line, top, and it typically keeps bouncing between these two lines. 2. Descending channel. In a downtrend, the price moves lower, creating a parallel downward range. The same concept applies. Prices tend to bounce between the resistance line, top, and support line, bottom. The beauty of channels is that they help you visualize the potential range of price movements, and they can act as dynamic support and resistance levels. If the price breaks out of the channel, it might signal a new trend or a potential reversal. Major reversal patterns. This is where things start to get really interesting. Reversal patterns are like the market's way of telling us that a trend is coming to an end and might be about to reverse direction. These patterns are key signals that can help you spot a potential change in the market, whether that's from bullish to bearish or bearish to bullish. Let's go over some of the most important reversal patterns that you need to know. 1. Head and shoulders. First up, we've got the classic head and shoulders pattern. This is one of the most reliable reversal patterns in technical analysis, and it tells you that a trend is about to change direction. In an uptrend, the pattern looks like a head with two shoulders, and it's called an inverted head and shoulders when it appears after a downtrend. The pattern forms when prices create three peaks. 1. The left shoulder. The price rises to a peak and then falls back. 2. The head. The price rises again to a higher peak, then falls again. 3. The right shoulder. The price rises again, but to a lower peak, then begins to fall. The key to this pattern is the neckline. This is the line connecting the troughs, the lowest points between the head and the shoulders. If the price breaks below the neckline after forming the right shoulder, it's a signal of a reversal. If it's an inverted head and shoulders after a downtrend, a breakout above the neckline indicates the trend might be turning upwards. 2. Double tops and double bottoms. Next, let's talk about double tops and double bottoms. These are simple yet powerful reversal patterns that occur after a trend and are pretty much exactly what they sound like. Double top. This is a bearish reversal pattern that forms after a strong uptrend. It occurs when the price hits a peak, pulls back, then rallies back up to the same level again before failing to break higher. The key level here is the support level between the two peaks. When the price breaks below that support level, it signals the potential for a downtrend. Double bottom. This is the opposite of the double top and is a bullish reversal pattern that happens after a strong downtrend. It forms when the price hits a low, rallies up, then comes back down to the same low again before starting to rise. When the price breaks above the resistance level between the two bottoms, it suggests the trend might be about to reverse upwards. 3. Triple tops and triple bottoms. Triple tops and triple bottoms are very similar to double tops and bottoms, but they provide stronger confirmation of a trend reversal because the price tests the key level 3 times instead of just 2. Triple top. This is another bearish reversal pattern that forms after a strong uptrend. It's essentially a more prolonged version of the double top, where the price hits the same resistance level 3 times before failing to break higher. When the price breaks below the support level after the third peak, it's a strong signal that the trend could be about to reverse. Triple bottom, the bullish reversal pattern to the triple top. It forms after a downtrend when the price hits the same support level 3 times before bouncing upwards. When the price breaks above the resistance level after the third bottom, it's an indication that the market could be about to turn bullish. Saucers. Next up, we have the saucer pattern. This is a slow and gradual reversal pattern that takes time to form, but is very powerful once it completes. In a bearish saucer, the price forms a gradual curve or saucer shape at the top of an uptrend, signaling a slow shift from an uptrend to a downtrend. In a bullish saucer, the price forms a similar shape, but at the bottom of a downtrend, signaling a slow shift from a downtrend to an uptrend. The key thing to remember here is that saucers are long-term patterns, so you'll want to keep an eye on them over time. They give you a heads up that a trend is weakening and could reverse soon. 5. V-shaped reversals. Finally, we have the V-shaped reversal. This one is exactly what it sounds like. A sharp, dramatic reversal in price, where the market forms a V-shape, either from down to up or up to down. V-shaped bottom. This happens after a downtrend when the market sharply drops, then suddenly reverses and shoots back up. It's a bullish reversal, indicating that the market has bottomed out and is ready to head back up. V-shaped top. This occurs after an uptrend when the price sharply rises, then plunges down in a sudden reversal. This is a bearish reversal, signaling that the trend might have peaked and is about to head downward. V-shaped reversals are fast and intense, so when they happen, they can completely shift market sentiment in a very short amount of time. Continuation patterns. These patterns are incredibly important because they tell us that the current trend is likely to continue after a brief pause or consolidation. In other words, continuation patterns give us a clue that the market is just taking a breath before continuing in the same direction. Now let's break down some of the key continuation patterns that you'll want to watch for when analyzing charts. 1. Triangles. First up, we've got triangles. Triangles are formed when price action is becoming narrower, usually because the market is consolidating after a strong trend. They come in 3 different shapes. Symmetrical triangle. This one happens when the price creates lower highs and higher lows, making the price movement narrower over time. The idea is that the market is stuck between 2 opposing forces, buyers and sellers. As the price squeezes, it's a sign of indecision, but eventually the market will break out in one direction, either up or down. Ascending triangle. This triangle is typically a bullish continuation pattern. It forms when the price creates higher lows, but the resistance stays at the same level. So the market keeps testing the resistance and forming higher lows, indicating that buying pressure is building. When the price breaks above the resistance, it's a sign that the uptrend might continue. Descending triangle. This one is the bearish cousin of the ascending triangle. It forms when the price creates lower highs, but the support stays at the same level. This shows that sellers are in control, pushing the price down. When the price breaks below support, it signals that the downtrend could continue. In all cases, triangles are about consolidation, and they act as a temporary pause in the current trend before the market breaks out in one direction. 2. Flags. Next, we have flags. Flags are continuation patterns that look exactly how they sound. They look like a flag on a pole. They form when the market makes a sharp price movement in one direction, the flagpole, followed by a brief consolidation, the flag, in the opposite direction. Bullish flag. This forms after an uptrend when the price makes a steep rise, then consolidates in a downward or sideways direction. When the price breaks above the flag's resistance line, it signals that the uptrend could continue. Bearish flag. This forms after a downtrend when the price makes a steep drop, then consolidates in an upward or sideways direction. When the price breaks below the flag's support line, it signals that the downtrend could continue. Flags are typically short-lived patterns, and the key is that the breakout from the flag typically happens in the same direction as the previous trend. 3. Pennants are very similar to flags, but they look a bit more narrow. They form when the price makes a sharp movement in one direction, then consolidates into a small symmetrical triangle. Bullish pennant. This forms after an uptrend when there's a sharp price rise, followed by a consolidation that forms a small triangle. When the price breaks out above the pennant's resistance line, it signals that the uptrend might continue. Bearish pennant. This forms after a downtrend when there's a sharp price drop, followed by a consolidation into a small triangle. When the price breaks below the pennant's support line, it signals that the downtrend might continue. Pennants are also short-term patterns that indicate a temporary pause before the market continues in the same direction as before. 4. Wedges. Wedges are similar to triangles, but there's an important difference. In a wedge, both trend lines are sloping in the same direction. Wedges can be either bullish or bearish. Rising wedge. This forms when both the support and resistance lines are sloping upward, but the price is moving in a more narrow range. A rising wedge after an uptrend is typically a bearish continuation pattern, signaling that the trend might be losing steam and could reverse downward once the price breaks below support. Falling wedge. This happens when both the support and resistance lines are sloping downward. A falling wedge after a downtrend is a bullish continuation pattern, indicating that the downtrend is likely to reverse, and the market could start moving upward once the price breaks above resistance. Wedges are typically reversal signals, but in the context of continuation patterns, they give us a heads up that the trend might continue after a break in the right direction. 5. Rectangles. Finally, we have rectangles, which are pretty straightforward. A rectangle forms when the price moves within a horizontal range between support and resistance. It's essentially a price consolidation period after a strong trend. Bullish rectangle. This forms after an uptrend when the price consolidates within a narrow range. If the price breaks above the rectangle's resistance line, it's a sign that the uptrend is likely to continue. Bearish rectangle. This forms after a downtrend when the price consolidates within a narrow range. If the price breaks below the rectangle's support line, it signals that the downtrend is likely to continue. Rectangles are classic consolidation patterns, and the breakout from the rectangle can help you predict the next leg of the trend, whether it's up or down. Volume and open interest. What is volume? First, let's talk about volume. In simple terms, volume refers to the number of shares or contracts traded in a specific time period. It's like the heartbeat of the market. If the price is moving but volume is low, it's not as convincing. But when the price moves and volume spikes, that's a strong signal that the move is likely to be real and not just a temporary fluctuation. High volume typically means high interest in the asset, and it helps validate a price movement. Imagine a bullish breakout. If the price goes up and volume increases, it confirms that buyers are in control. On the flip side, if the price moves up but volume stays low, it might mean that the price move is weak and could be easily reversed. Volume gives us insight into the strength of a price move, helping us gauge whether it's likely to be a sustainable trend or just a temporary spike. What is open interest? Next up, open interest. This is a term you'll hear mostly in futures markets. Open interest refers to the total number of unsettled contracts, whether long or short, that are still open in the market. Essentially, it tells you how many futures contracts have not been closed out or offset. Open interest gives us a sense of market participation. If there's high open interest, it indicates that many traders are involved and there's a strong market presence. On the other hand, low open interest might suggest that the market is less active and there's not as much commitment from traders. When analyzing open interest, it's important to understand that increasing open interest usually happens when there's a strong trend. When open interest rises alongside price, it suggests that the trend is likely to continue. But if open interest falls while the price is rising, it could indicate that the market is losing interest in the trend and a reversal may be on the horizon. How volume and open interest work together. Now, the real magic happens when we combine volume and open interest. Let's break it down with some scenarios to make it clear. 1. Confirming a trend. If volume is high and open interest increases, this generally means that the trend is strong and sustainable. For example, let's say a market is in an uptrend, and both volume and open interest are rising. This tells us that new buyers are coming in and existing positions are being maintained. This is a bullish sign, suggesting that the uptrend is likely to continue. 2. Reversal signals. What about when volume is high, but open interest is falling? This situation might indicate that traders are exiting their positions, which suggests that the market could be losing interest in the trend. For instance, if the price is going up but open interest is dropping, it might mean that the bullish move is running out of steam, and the market could be ready for a reversal. Mar 3. Fake moves. Now, what if you see high volume but low open interest? This is a tricky one. It could mean that there's a lot of short-term activity, like day trading or speculative moves, but there isn't much long-term commitment. This can often signal that the price movement could be a fake out and not part of a larger trend. Essentially, the market is moving, but not enough traders are staying involved to give the move staying power. 4. Low volume and low open interest. Lastly, if both volume and open interest are low, it signals a lack of market participation. The market is likely in a stale, quiet phase. Price movements in this environment might be erratic, and it's harder to trust those moves as being part of a solid trend. Volume and open interest in futures markets. In futures markets, the combination of volume and open interest becomes even more crucial because it gives us insight into not just the current trend, but also the market sentiment and trader commitment. For example, in a futures market, let's say prices are rising, but open interest is falling. This could indicate that long positions are being closed and traders are no longer confident in the market's direction, signaling potential reversal. Conversely, if prices are rising and open interest is rising, it tells us that the trend is likely to continue, with more traders jumping on the bandwagon. Long-term charts. In this chapter, we're talking about using weekly and monthly charts to spot macro trends, those big picture movements that guide the market over the long haul. What are long-term charts? So what exactly are long-term charts? They're charts that cover a longer time period than your typical daily or intraday charts. A weekly chart shows price movements over the course of a week, and a monthly chart shows price movements over a month. The main benefit of these long-term charts is that they help you spot macro trends, the big overarching trends that can last for months or even years. These trends are important because they give you the big picture, helping you avoid getting caught up in the noise of short-term fluctuations. Why use long-term charts? You might be wondering, why should I look at these long-term charts when I'm more focused on short-term price movements? Well, the answer is simple. Long-term charts help you align your trades with the bigger trend. If you can identify the overall direction of the market on the weekly or monthly charts, you can make smarter trades on the smaller time frames, riding the wave of the larger trend. How to use weekly and monthly charts. When you're looking at weekly and monthly charts, the main goal is to identify the dominant trend. This is your macro trend, which could be a long-term uptrend where the market is generally moving higher over time, a long-term downtrend where prices are steadily moving lower, a sideways trend, also known as a range-bound market, where prices are stuck within a certain range and moving horizontally. By identifying these trends, you get a much better sense of where the market is heading in the long run, and this can help you make better decisions about when to buy, sell, or hold positions. Key things to look for in long-term charts. 1. Trend lines. Just like in shorter-term charts, trend lines are essential on long-term charts. A trend line connects the lows in an uptrend or the highs in a downtrend, helping you visualize the general direction of the market. On weekly and monthly charts, a well-placed trend line can show you the strength of the trend and whether it's likely to continue. If the price is consistently staying above an upward-sloping trend line, it's a good sign that the uptrend is strong. If the price is bouncing off a downward-sloping trend line, it signals that the downtrend might continue. 2. Moving averages. Another tool to use in long-term charts is moving averages, specifically the 50-week and 200-week moving averages, or their monthly counterparts. These moving averages help smooth out the price action and show you the overall direction of the trend. If the price is above the moving average, it's generally a bullish sign, indicating that the market is in an uptrend. If the price is below the moving average, it's a bearish sign, suggesting that the market is in a downtrend. Using these longer period moving averages can help you identify major trend changes, like when a bull market starts to shift into a bear market. Chapter 3. Support and resistance levels. When looking at long-term charts, support and resistance levels become even more significant. These are the price levels where the market has reversed in the past, and they can act as psychological barriers in the future. If the price is approaching a long-term support level and holding above it, it might signal that the market is going to continue moving up. Conversely, if the price is testing a resistance level and failing to break through, it could indicate that the market is going to reverse downward. 4. Patterns. Patterns like head and shoulders, double tops, double bottoms, and triangles can also appear on long-term charts. These patterns, especially when they play out over weeks or months, can indicate significant trend reversals or continuations. For instance, a head and shoulders on a weekly chart could be a powerful signal that a long-term trend is about to reverse. The power of long-term charts in trading. So why does all of this matter? Long-term charts help you focus on the big picture. They allow you to filter out the noise that comes with short-term fluctuations and focus on where the market is headed over months or even years. By identifying the dominant macro trend, you'll be in a much better position to stay on the right side of the market. If the market is in a strong uptrend, you'll know that buying dips is a smart strategy. If the market is in a downtrend, you might focus on shorting rallies. Avoid false signals. On short-term charts, price can be erratic and give false signals. But when you zoom out and look at the bigger trend on a weekly or monthly chart, you'll have a clearer idea of where the market is likely to go. Capture big moves. By trading in the direction of the long-term trend, you're more likely to catch bigger price moves. You're not just trading for small profits, but positioning yourself to ride the market's momentum over the long haul. Real-world example. Let's say you're looking at the monthly chart of a stock. You notice that the price has been in a long-term uptrend for several years, with occasional corrections along the way. This long-term trend is strong, and even though the stock has pulled back recently, you can see that the overall market sentiment is still bullish. Now, looking at the weekly chart, you spot a bullish continuation pattern or the price bouncing off a key support level. This confirms that the stock is likely to continue its upward movement. With the macro trend on your side, you decide to enter the trade, positioning yourself to profit from the continued uptrend. Moving averages, a fundamental tool in technical analysis that can really help smooth out price action and highlight trends. This chapter focuses on different types of moving averages, how to use them effectively, and how they can give you valuable insights into the market's direction. What are moving averages? A moving average, MA, is a trend-following indicator that helps you smooth out price data by creating a constantly updated average price. The idea is to eliminate the noise of daily price movements, giving you a clearer view of the trend. Moving averages can be incredibly helpful in identifying trends, spotting trend reversals, and generating potential buy or sell signals. They show the average price of an asset over a specified period, so they're like a snapshot of price action over time. Types of moving averages. 1. Simple moving average SMA. The simple moving average is the most basic type of moving average. It's calculated by taking the average price of an asset over a specific number of periods. For example, a 50-day SMA is calculated by averaging the closing prices of the asset over the past 50 days. Pros? It's straightforward and easy to calculate, making it great for identifying general trends. Cons? Because it gives equal weight to all data points, it can be slow to react to recent price changes, especially in volatile markets. 2. Exponential moving average, EMA. The exponential moving average, EMA, is similar to the SMA, but with one key difference. The EMA gives more weight to the most recent prices. This makes it more sensitive to recent price movements, which can be really helpful in fast-moving markets. Pros? It reacts more quickly to price changes, giving you more up-to-date signals. Cons? It can be more prone to false signals because it's quicker to react to price fluctuations. Both SMAs and EMAs are widely used, but the EMA is generally preferred by traders who want to react more quickly to price changes. 3. Weighted moving average, WMA. The weighted moving average is similar to the EMA in that it gives more importance to recent price data, but it does so in a slightly different way. Instead of applying a smooth curve, the WMA assigns specific weights to each data point. It's more responsive than the SMA, but can be more complex to calculate and interpret. Cons: it might overemphasize the most recent data, potentially leading to overreaction in volatile markets. Moving average crossovers. One of the most popular ways to use moving averages is through crossovers. A crossover happens when two moving averages of different time periods cross over each other, signaling a potential change in the market's direction. Bullish crossover. This happens when a short-term moving average, like the 50-day EMA, crosses above a long-term moving average, like the 200-day EMA. This is often seen as a bullish signal, indicating that the market might be entering an uptrend. Bearish crossover. A bearish crossover happens when a short-term moving average crosses below a long-term moving average. This is considered a bearish signal, often indicating the potential start of a downtrend. Crossovers are simple to spot and are often used by traders to trigger buy or sell decisions. But remember, they can sometimes be late signals, meaning the market might already be in motion by the time the crossover happens. Moving average envelopes. Moving average envelopes are a more advanced concept. These are bands placed a fixed percentage above and below a moving average. The idea is to create an envelope or range around the moving average. The price moves within this envelope, and traders watch for signs of price breaking out or reversing. When the price touches the upper envelope, it could be a signal of overbought conditions, meaning the price may reverse or pull back. When the price touches the lower envelope, it could signal oversold conditions, indicating a possible reversal to the upside. Envelopes work well to identify periods of extreme price moves and potential trend reversals. They help traders avoid getting caught in false breakouts by providing a contextual range for the market. How to use moving averages effectively. Trend identification. One of the main uses of moving averages is to identify trends. If the price is above a moving average, it suggests that the market is in an uptrend. And if it's below the moving average, the market is likely in a downtrend. By using longer period moving averages, like the 200-day EMA, you can identify long-term trends. Shorter period moving averages, like the 50-day EMA, help you spot short-term trends. Support and resistance. Moving averages can also act as dynamic support and resistance levels. In an uptrend, the price might pull back to the moving average and then bounce higher off it. In a downtrend, the price may pull back to the moving average and then reverse downward. Combining moving averages with other indicators. Moving averages are often combined with other technical indicators to improve their accuracy. For example, you could use them in conjunction with RSI, Relative Strength Index, to confirm whether the market is overbought or oversold. Or you could use MACD, Moving Average Convergence Divergence, to get additional confirmation of trend changes. Real-world example. Let's say you're looking at the 50-day EMA and the 200-day EMA for a stock. The price has been moving in a general uptrend for the past few months, staying above the 200-day EMA. You see a bullish crossover when the 50-day EMA crosses above the 200-day EMA. This is a strong buy signal. You enter the trade, but you also notice that the stock is approaching the upper envelope of its moving average range, signaling that it might be overbought. You decide to monitor the price action closely for any signs of reversal, giving you an extra layer of insight into your trade. Oscillators and contrary opinion, where we'll explore some powerful tools that can help you fine-tune your market analysis and potentially predict reversals. In this chapter, we focus on oscillators, which are a type of indicator used to measure momentum, and contrary opinion indicators, which give insights into market sentiment. What are oscillators? Oscillators are technical indicators that oscillate between two fixed values, typically ranging from 0 to 100, and they are used to determine whether an asset is overbought or oversold. These indicators give you insights into market momentum, helping you spot potential trend reversals or continuations. Let's break down the key oscillators. 1. Relative Strength Index, RSI. The Relative Strength Index, RSI, is one of the most popular oscillators in technical analysis. It measures the speed and change of price movements and ranges from 0 to 100. An RSI reading above 70 is generally considered overbought, while a reading below 30 is considered oversold. How to use RSI. When the RSI hits overbought or oversold conditions, it often signals a possible reversal. However, the market can remain overbought or oversold for long periods during strong trends, so it's important to confirm with other indicators. Divergence with RSI. One of the most powerful signals RSI provides is divergence. When the price is making new highs, but the RSI is not following suit, or vice versa, it signals weakening momentum, often preceding a reversal. For example, if the price is making a new high, but the RSI is lower than its previous high, this could be a sign that the uptrend is losing momentum. That's a potential sell signal. 2. Stochastic oscillator. The stochastic oscillator is another momentum indicator that compares a specific closing price to a range of prices over a given time period. It oscillates between 0 and 100 and is often used to identify overbought or oversold conditions. Overbought oversold levels, like RSI, values above 80 indicate overbought conditions, and values below 20 indicate oversold conditions. The K-cent K line, the fast line, and the cent D line, the slow line, are key components of the stochastic oscillator. When the cent K line crosses above the cent D line in oversold conditions, it can signal a buy opportunity, while a crossover in overbought conditions may signal a sell. Part 3. MACD, Moving Average Convergence Divergence. The MACD is a trend-following momentum indicator that shows the relationship between two moving averages of an asset's price, the 12-day EMA and the 26-day EMA. How it works. The MACD line is the difference between these two EMAs, and it fluctuates above and below the 0 line. A signal line, 9-day EMA of the MACD line, is used to generate buy or sell signals. How to use MACD. A bullish crossover occurs when the MACD line crosses above the signal line, suggesting a potential buying opportunity. A bearish crossover happens when the MACD line crosses below the signal line, suggesting a potential selling opportunity. Divergence with MACD. Like RSI, the MACD can also show divergence. If the price is making new highs, but the MACD is failing to keep up, it could indicate a weakening uptrend, signaling a potential reversal. 4. Divergence in oscillators. Divergence is one of the most important concepts to understand when using oscillators. Divergence occurs when the price of an asset moves in the opposite direction of an oscillator, signaling that the current trend may be losing momentum and could be about to reverse. Bullish divergence. When the price makes a lower low, but the oscillator makes a higher low, it suggests that selling momentum is weakening, and a reversal to the upside could be coming. Bearish divergence. When the price makes a higher high, but the oscillator makes a lower high, it indicates that buying momentum is weakening, and a reversal to the downside could be imminent. Understanding divergence in oscillators helps you spot moments when a trend might be running out of steam, giving you a heads up before the trend turns. Contrary opinion indicators. While oscillators focus on market momentum, contrary opinion indicators focus on market sentiment. These indicators give you a sense of whether investors are too bullish or bearish, which can signal potential market extremes. 1. Put-call ratio. The put-call ratio is a sentiment indicator that compares the number of put options, which bet on the market going down, to call options, which bet on the market going up. High put-call ratio. A high ratio suggests that there is fear in the market, with more people betting against the market. This can often signal oversold conditions and a potential buying opportunity. Low put-call ratio. A low ratio suggests optimism, with many investors betting on the market going up. This could signal overbought conditions and a potential selling opportunity. 2. VIX Volatility Index. The VIX, also known as the Fear Index, measures market volatility. When the VIX is high, it indicates that there is a lot of uncertainty and fear in the market, often signaling that the market is oversold. When the VIX is low, it suggests optimism and can indicate that the market is overbought. A high VIX can often coincide with market bottoms, signaling a potential buying opportunity. A low VIX can indicate market tops, suggesting that a correction or reversal might be on the horizon. How to use oscillators and contrary opinion indicators together. By combining oscillators like the RSI, stochastic, and MACD with sentiment indicators like the put-call ratio and the VIX, you can gain a much clearer understanding of market conditions. For example, let's say you're looking at the RSI and notice that it's above 70, signaling an overbought market. At the same time, you look at the put-call ratio and notice that it's extremely low, suggesting extreme optimism in the market. Together, this could signal that the market is due for a reversal. Real-world example. Let's say you're analyzing a stock. The price has been climbing, but the RSI is now overbought above 70. At the same time, the MACD shows a bearish crossover, and you see divergence between the price and the oscillator. To add to that, the put-call ratio is very low, indicating excessive bullish sentiment. With all these signals lining up, you might decide it's time to exit your position or even take a short position, anticipating a market reversal. Point and figure charting. In this chapter, we're diving into an exciting yet often underappreciated tool in technical analysis, point and figure P&F charting. If you're looking for a cleaner, simpler way to spot trends and price movements without all the clutter, this charting method might be exactly what you need. Unlike traditional charts that focus on both time and price, P&F charts are price-only charts, meaning they focus purely on the price action, ignoring time altogether. Let's break it down. What is point and figure charting? Point and figure charts are unique because they don't plot every single price change. Instead, they only mark price movements that are significant enough to overcome a certain box size. This makes P&F charts less cluttered and more focused on the big picture, helping you see clearer trends without the noise that can sometimes come from traditional charts. Key components of P&F charts. The main components you'll need to understand in point and figure charting are box size. This refers to the price increment that needs to be reached before a new mark, or X for upward movement or O for downward movement, is plotted. The box size determines how sensitive the chart is to price movement. The larger the box size, the less frequently the chart will update, while a smaller box size will reflect smaller price movements more frequently. Reversal amount. The reversal amount tells you how much the price has to move in the opposite direction to change the direction of the marks. For example, if the price goes up by 3 boxes, X's, and the price reverses by 2 boxes, it'll switch to O's and start plotting downward movement. How point and figure charts work. 1. Price movement. The basic idea of a P&F chart is simple. When the price moves higher by a certain amount, depending on the box size, you plot an X on the chart. If the price moves lower by the same amount, you plot an O. 2. Box size and reversal. If the price moves higher than the previous price by the box size, an X is drawn in the column. If the price moves lower by the same amount, an O is drawn in the column. Once a new trend starts, the chart continues until the price moves in the opposite direction, enough to trigger a reversal, at which point a new column of X's or O's starts. 3. No time factor. What makes P&F charts different from traditional charts is that they don't account for time. So a box might take a few minutes or a few days to fill, but time itself isn't plotted on the chart. This makes the chart much cleaner and easier to read, without being distracted by the ups and downs of daily price fluctuations. Trendline analysis in P&F charts. One of the most powerful aspects of point and figure charting is trendline analysis. You can draw support and resistance lines, just like in traditional charting, but P&F charts often provide clearer signals because they only focus on meaningful price movements. Uptrend lines. In an uptrend, the X's form a series of higher highs, and you can draw a trend line along the bottoms of the X's. This will serve as your support level. If the price drops below this trend line, it could indicate a reversal. Downtrend lines. In a downtrend, the O's form a series of lower lows, and you can draw a trend line along the tops of the O's. If the price rises above this trend line, it could signal a potential reversal to the upside. Breakouts. When the price moves beyond these trend lines, you might see a breakout, which could be a signal for a strong move in the direction of the breakout. Benefits of point and figure charts. Noise reduction. One of the main advantages of P&F charting is that it eliminates market noise. Because the chart only tracks price changes that are meaningful enough to overcome the set box size, you won't be overwhelmed by small fluctuations in price. Trend-focused. Since P&F charts are purely focused on price and trends, they are particularly useful for identifying strong trends and key support and resistance levels, making it easier to spot potential buy or sell signals. Simplicity. Point and figure charts are relatively simple and straightforward to interpret, making them an excellent choice for traders who prefer clean, easy-to-read charts. Real-world application. Let's put this into a real-world context. Imagine you're analyzing a stock and you see a series of X's on the chart. These X's represent an uptrend. However, as the price begins to reverse and starts creating O's, you'll see this clearly on the chart, and you'll be able to identify that the trend may be coming to an end. Let's say you're watching a stock in a downtrend with a series of O's. If the price reverses and you start seeing X's forming above a specific level, that could be a bullish signal, and if the X's break a trend line of resistance, you might consider it a breakout. Japanese candlesticks. Now let's dive into one of the most popular and powerful tools in technical analysis. Japanese candlesticks. If you're trading or analyzing charts, understanding candlestick patterns is like unlocking a hidden language that tells you about the market's emotions and potential future movements. These patterns, with their distinctive shapes, give you deep insights into bullish and bearish sentiment, reversal signals, and continuation patterns. What are Japanese candlesticks? A candlestick is made up of 4 key price points. Open, the price at which the asset starts trading within a specific time period. Close, the price at which the asset finishes trading within that period. High, the highest price reached during the time period. Low, the lowest price reached during the time period. The body of the candlestick represents the open and close prices. The wick, or shadow, above and below the body shows the high and low prices. The color of the body, usually green or white for up and red or black for down, tells you whether the price closed higher or lower. Candlestick patterns. Candlestick patterns are formed when these price points combine in specific ways. Let's look at some of the most common patterns that traders rely on. 1. Doji. The doji is one of the most important candlestick patterns. A doji occurs when the open and close prices are nearly the same, forming a very small body with long wicks. This represents indecision in the market. Buyers and sellers are at a standoff, and a potential trend reversal could be coming. Bullish doji. After a downtrend, if a doji appears, it could signal that the bears are losing their grip and a bullish reversal might be on the horizon. Bearish doji. After an uptrend, a doji could mean that the bulls are losing momentum, signaling a possible bearish reversal. K2. Engulfing patterns. An engulfing pattern is a two-candle pattern that can signal strong reversals. There are two types. Bullish engulfing. This occurs when a small red candlestick is followed by a larger green candlestick that completely engulfs the red one. This shows that buyers are in control and could signal the start of an uptrend. Bearish engulfing. This happens when a small green candlestick is followed by a larger red candlestick that engulfs the green one. This shows that sellers are overpowering and might indicate the beginning of a downtrend. 3. Hammer. The hammer is a bullish reversal pattern that appears after a downtrend. It has a small body near the top of the candlestick with a long wick beneath it. This shows that, although sellers controlled the price at some point, buyers pushed the price back up by the close, indicating a potential bullish reversal. Inverted hammer. A hammer with the wick at the top and a small body near the bottom can also indicate a reversal to the upside, especially when it appears at the bottom of a downtrend. Tamer 4. Hanging man. The hanging man looks identical to the hammer, but its meaning is the opposite. It appears after an uptrend and signals a potential bearish reversal. The long lower wick shows that there was significant selling pressure during the period, but buyers managed to push the price back up by the close. However, since it appears after an uptrend, it suggests that the buying momentum is weakening and a downtrend may follow. 5. Shooting star. The shooting star is similar to the inverted hammer, but it appears after an uptrend. It has a small body near the bottom and a long wick above. The shooting star is a bearish reversal pattern, indicating that buyers tried to push prices higher but failed, and sellers took control, potentially signaling a trend reversal to the downside. 6. Morning star and evening star. Morning star. This is a three-candle pattern that indicates a bullish reversal. It starts with a long red candle, followed by a small body, indicating indecision, and ends with a long green candle. This pattern signifies that the bears are losing control and the bulls are starting to dominate. Evening star. The evening star is the opposite, signaling a bearish reversal. It starts with a long green candle, followed by a small body, and ends with a long red candle. This suggests that after the uptrend, the bulls are losing momentum and the bears are taking over. Ha7. Dark cloud cover. The dark cloud cover is a bearish reversal pattern that occurs when a green candle is followed by a red candle that opens above the previous close but closes below the midpoint of the green candle. This shows that, although the price initially tried to rise, the bears have gained control and could push the price lower. Tom 8. Piercing pattern. The piercing pattern is a bullish reversal pattern that appears after a downtrend. It happens when a red candle is followed by a green candle that opens below the previous candle's close, but closes above its midpoint. This shows that the bulls have successfully taken control after a period of selling. How to use candlestick patterns. While candlestick patterns are powerful, it's important to contextualize them. For example, a doji at the top of an uptrend or the bottom of a downtrend could signal that the market is about to reverse. But for confirmation, you should always combine candlestick patterns with other indicators like volume, trend lines, or moving averages. Elliott wave theory. Let's jump into one of the most intricate yet fascinating theories in technical analysis, Elliott wave theory. If you've been trading or analyzing markets for any length of time, you've probably heard of it. It's a powerful way to understand market cycles and price movement by breaking them down into a series of waves that repeat in a predictable manner. This theory, developed by Ralph Nelson Elliott, gives us a deeper understanding of the market's psychology and how price moves in patterns influenced by human emotion. What is Elliott wave theory? At its core, Elliott wave theory is built around the idea that market prices move in a repetitive cycle. According to Elliott, the market moves in a pattern of impulse waves and corrective waves. Impulse waves are the waves that drive the market in the direction of the primary trend. Corrective waves are the waves that move against the trend, correcting the previous impulse wave. The theory is all about psychological mass, the collective emotions of traders and investors that drive the price movements. These emotions form identifiable patterns. Impulse waves and corrective waves. Elliott's waves break down into two types. Impulse waves, which are in the direction of the primary trend, and corrective waves, which move against the trend. Together, they form a complete cycle. 1. Impulse waves. Impulse waves are the strong waves that push the market in the direction of the prevailing trend. They are always labeled 1, 2, 3, 4, and 5, where Wave 1, the first initial push in the direction of the trend. Wave 2, a brief correction against the trend, typically retracing part of Wave 1. Wave 3, the strongest and longest wave, driving the trend forward with momentum. Wave 4, another correction against the trend, but not as deep as Wave 2. Wave 5, the final push in the direction of the trend, often the last major move before the trend starts to reverse. These impulse waves are essentially the market's motive waves. They reflect the market's collective energy pushing in one direction. 2. Corrective waves. After the impulse waves, the market goes through a correction. These waves typically move against the main trend, labeled A, B, and C. These are much slower and less decisive than impulse waves and can take several different forms. Wave A, the first wave of the correction, which is often mistaken for the start of a new trend. Wave B, the market attempts to correct the correction, moving in the direction of the previous impulse waves, but usually failing to regain its previous highs. Wave C. This is the final wave of the correction, usually moving in the same direction as Wave A, and it often marks the end of the correction before the next set of impulse waves begins. Fibonacci ratios in Elliott wave theory. Elliott wave theory heavily incorporates Fibonacci ratios, a fundamental mathematical sequence that appears in many aspects of nature and finance. These ratios are used to estimate the possible extent of corrections and the length of impulse waves. Wave 2 typically retraces between 50% and 61.8% of Wave 1. Wave 4 typically retraces between 23.6% and 38.2% of Wave 3. Wave 3 is often a 1.618 extension of Wave 1. Wave 5 can often extend to 2.618 or 4.236 times the length of Wave 1. These ratios give traders a mathematical framework for predicting price movement and understanding the potential size of waves. Cycle analysis. Elliott also identified that these waves occur in cycles. The cycle can be broken down into smaller timeframes, with each set of 5 impulse waves and 3 corrective waves forming a larger cycle. These cycles can repeat at different degrees, and the market moves in a fractal pattern. Primary cycles. These represent long-term cycles of price movement. Intermediate cycles. These are smaller cycles that form within the primary cycles. Minor cycles. These are even smaller waves that fit within the intermediate cycles. Each wave interacts with the next, creating a fractal-like structure where the same patterns repeat at different levels of time and scale. Understanding this cycle allows traders to predict where they are within the cycle and adjust their strategies accordingly. How to use Elliott wave theory. Using Elliott wave theory can seem daunting at first, but once you understand the basic structure of the waves, it becomes a powerful tool for market analysis. The key is to 1. Identify the trend. Is the market in an impulse wave or corrective wave phase? 2. Look for patterns. Identify the 5-wave impulse and 3-wave correction pattern. 3. Apply Fibonacci ratios. Use these ratios to predict the length and depth of waves. 4. Watch for the cycles. Understand where the market is within the larger cycle to anticipate future moves. Elliott wave analysis works best when combined with other technical tools, such as trend lines, support and resistance, and moving averages to confirm signals. Time cycles. Welcome to the intriguing world of time cycles in market analysis. Time isn't just a backdrop in trading, it actually plays a pivotal role in predicting price movements. In this chapter, we're diving into how different seasonal cycles, long-term economic waves, and other time-based patterns shape the market. It's all about understanding how the passage of time influences investor behavior, market trends, and price movements. What are time cycles in market analysis? Time cycles, in simple terms, are repeating patterns that occur at regular intervals in the market, often influenced by a mix of economic, seasonal, and psychological factors. By studying past trends, we can predict when certain market conditions are likely to repeat. In other words, the past can tell us about the future. Time cycles are important because they help traders and analysts anticipate the timing of market movements. By understanding these cycles, you can align your trades with periods of expected volatility or market stability. Seasonal cycles. One of the most widely studied forms of time cycles is seasonal cycles. These cycles are driven by factors like weather patterns, holidays, and other annual events that affect supply and demand in the market. For example, in the agriculture markets, there are predictable patterns that occur because of planting seasons and harvest periods. Similarly, retail stocks tend to rise before the holiday season as people ramp up their spending. In commodities like energy or precious metals, there are also seasonal patterns, such as oil prices often rising during the colder months when demand for heating increases. Even broader market trends can have seasonal tendencies. Historically, stock markets tend to be stronger in the second half of the year, with summer months generally being slower and fall-winter months seeing a rebound in activity. Traders who understand these seasonal tendencies can make more informed decisions by anticipating when markets are likely to experience periods of strength or weakness. Kondratiev. Kondratiev waves, named after Russian economist Nikolai Kondratiev, represent one of the most fascinating long-term cycles in economic history. Kondratiev theorized that the global economy moves in 50-year cycles, each cycle marked by periods of growth and decline. These cycles are driven by major technological, social, and economic changes, such as the introduction of new technologies or shifts in geopolitical power. Each wave has 4 distinct phases. 1. Expansion. This is when innovation and new technologies fuel economic growth. 2. Crisis. As growth slows, the economy faces challenges. 3. Recession. The global economy enters a period of contraction. 4. Recovery. The economy begins to rebuild, setting the stage for the next expansion. For instance, the first Kondratiev wave, which began around the 1800s, was marked by the rise of the steam engine and the Industrial Revolution. The most recent Kondratiev cycle, according to some analysts, began in the 1940s, coinciding with post-World War II reconstruction and the rise of the information technology age. Understanding where we are in the cycle can provide long-term investors with a broader perspective on market trends and economic conditions. Time-based market patterns. In addition to the well-known cycles, markets also show time-based patterns that repeat over different timeframes, whether daily, weekly, monthly, or long-term cycles. These patterns can reflect investor behavior, psychological cycles, and how markets react to recurring events. For example, weekly and monthly patterns. You may notice that the market tends to follow a Monday effect, where stocks often have a positive bias at the start of the week, or a Friday effect, where markets show strength as traders close their positions before the weekend. These are time-based patterns that seem to repeat over time. Decennial patterns. Over the years, traders have observed that certain years, like the third year of a U.S. presidential cycle, often exhibit a tendency for market rallies. These patterns are driven by economic policies, investor psychology, and seasonal shifts. By studying these time-based patterns, traders can potentially spot reversal points, consolidation zones, or breakout opportunities, depending on where the market is in its cycle. How to use time cycles in your trading strategy. Understanding time cycles doesn't mean you can predict the exact price movement of a stock or commodity, but it does give you a timing edge in your trades. Here's how you can use time cycles to improve your trading strategy. 1. Use historical data. Look at how markets have behaved during certain times of the year or over specific economic cycles. This helps you understand the market's rhythm. 2. Look for repetitive patterns. Identify repeating cycles in your charts, whether they are seasonal cycles, long-term economic waves, or time-based patterns within a given time frame. 3. Combine time cycles with other technical indicators. The best way to apply time cycles is to combine them with other technical analysis tools, like support and resistance levels, trend lines, and oscillators for stronger signals. 4. Stay flexible. Time cycles aren't set in stone. They can evolve with new economic, geopolitical, and technological developments. So adapt your strategy based on how cycles unfold. Computers and trading systems. In this chapter, we're diving into the world of automated trading systems, backtesting, and algorithmic trading. With the rise of technology, computers have become an essential tool in modern trading, enabling traders to execute strategies more efficiently and consistently. But how does it all work? Let's break it down. Building automated trading systems. At the heart of the modern trading world lies automation. Automated trading systems are programs designed to execute trades on your behalf based on predefined criteria without the need for manual intervention. These systems can analyze market data, identify trading opportunities, and make decisions faster than any human could. But how do these systems make decisions? Well, they use complex algorithms and rules to spot patterns in price movements, trends, and volume data. For example, an automated system might be programmed to buy a stock when the price rises above a specific moving average and sell when it drops below a certain threshold. Building your own trading system involves defining your entry and exit strategies, setting risk parameters, and determining the right technical indicators. It's like creating a robot that follows your trading strategy perfectly, every time. Backtesting, testing your strategy. Before you launch your system in the real world, it's crucial to see how it performs. This is where backtesting comes into play. Backtesting allows you to test your automated trading system on historical market data to see how it would have performed in the past. This step is essential because it helps you evaluate whether your system is actually profitable or if it needs fine-tuning. By feeding your trading strategy into historical data, you can simulate how it would have reacted to different market conditions. Bull markets, bear markets, volatile times, and calm periods. While backtesting can give you a solid idea of how a strategy might perform, it's important to remember that past performance is not always indicative of future results. But it's still a valuable tool to refine and improve your system before live trading. Algorithmic trading, letting the machines trade for you. Algorithmic trading refers to using advanced mathematical models to execute trades at high speeds and volumes, often in milliseconds. This isn't about buying a stock based on a gut feeling. It's about using complex algorithms that analyze vast amounts of data, spot trading signals, and execute trades in real time. These algorithms are used to automate everything from market making, providing liquidity to markets, to statistical arbitrage, profiting from price discrepancies between related assets. The goal of algorithmic trading is to optimize the entry and exit points, improve trade execution, and reduce trading costs. Imagine this. While you're sleeping, an algorithm could be executing trades based on real-time market analysis, making the most out of every opportunity. It's like having a super fast, incredibly intelligent trading partner working 24/7 for you. The benefits of computers in trading. The use of computers and automated systems has revolutionized the trading world, offering several advantages. 1. Speed and efficiency. Computers can process massive amounts of data in the blink of an eye and execute trades in fractions of a second, faster than any human could. 2. Eliminating emotion. Automated systems take emotions out of trading. A machine doesn't get scared in a market downturn or greedy in a rally. It just follows the rules, ensuring that your strategy is executed precisely as planned. 3. Backtesting and optimization. As mentioned earlier, backtesting lets you test your strategies before putting real money at risk. This allows for continuous improvement of your trading system. 4. 24/7 trading. Algorithms don't sleep. They can work around the clock, tracking global markets and executing trades at the best times, even when you're not in front of your computer. Challenges of automated trading. While automated trading has many advantages, it's not without its challenges. 1. Technical failures. Computers and systems can experience glitches. If a trading algorithm malfunctions, it could lead to significant losses before you even notice. 2. Over-optimization. There's a risk of overfitting during backtesting, where your system performs perfectly on historical data but fails in live markets due to minor changes in market conditions. 3. Market risks. Algorithmic trading is not foolproof. It still depends on market conditions. The market can behave unpredictably, and no algorithm can predict every move. Sometimes, automated systems can even accelerate market volatility during certain events. Money management and trading tactics. In this chapter, we're diving deep into one of the most crucial aspects of trading, money management. Whether you're just starting out or a seasoned trader, understanding how to manage your money and control risk is essential for long-term success in the market. Let's explore risk-reward ratios, stop-loss placements, position sizing, and the psychology behind it all. Risk-reward ratios. Setting expectations. When it comes to trading, the risk-reward ratio is one of the first things you need to understand. This ratio is a key tool for assessing whether a trade is worth taking. Simply put, it's the amount of risk you're willing to take on a trade compared to the potential reward. For example, if you're willing to risk $100 on a trade and your potential profit is $300, then your risk-reward ratio is 1:3. This means for every dollar you're risking, you expect to gain 3 in return. A higher risk-reward ratio means you're aiming for bigger profits relative to your risk. But here's the catch. Not every trade will work out. You'll take losses. But with a good risk-reward ratio, even if you lose a few trades, you can still come out ahead overall. Aim for a minimum risk-reward ratio of 1 or higher, meaning you're risking $1 to potentially make $2. This approach helps ensure your winners can compensate for the occasional loss. Stop-loss placement, protecting your capital. A stop-loss is one of the most powerful tools for managing risk. It's a predefined exit point where you decide to cut your losses if the market moves against you. This strategy helps protect your trading capital and prevents emotional decision-making in the heat of the moment. But the real challenge is where to place the stop-loss. It shouldn't be too tight, or you risk getting stopped out of good trades, and it shouldn't be too far from the entry point, or you might expose yourself to larger losses. The key is to place it just beyond a significant support or resistance level, based on the chart pattern. This way, you're giving the trade enough room to breathe without risking too much. Stop-loss placement is all about balancing risk. If your stop-loss is too tight, you might exit trades too early. If it's too wide, you could lose more than you're comfortable with. It's a fine line, but when done right, it's a game changer. Position sizing. How much to risk per trade? Another critical piece of the puzzle is position sizing. This refers to how much capital you allocate to each trade. If you're trading with $10,000, for example, and you decide to risk 1% per trade, that means each trade should risk no more than $100. Why is position sizing so important? Because it helps control your overall exposure to risk. Even if you're a great trader, losing streaks happen. Without proper position sizing, a series of losses could wipe you out. But with the right sizing, you can take losses in stride and keep your capital intact. You don't have to risk the same amount on every trade. You can adjust based on your confidence level, market conditions, or the size of the trade setup, but always ensure that your overall risk across all trades stays within a manageable range. Trading psychology, mastering your mind. The mental side of trading is often overlooked, but it's just as important as the technical and financial aspects. Trading psychology is about controlling your emotions, managing your stress, and staying disciplined in the face of wins and losses. One of the biggest challenges traders face is fear and greed. Fear can cause you to exit a trade too early or not take a trade at all. Greed can push you to hold on to a trade for too long or take unnecessary risks. Both can ruin your account balance if not kept in check. To overcome these emotions, it's important to stick to your plan. You've already set your stop losses, risk-reward ratios, and position sizes, so there's no need to second-guess yourself. Trust the system. Avoid chasing the market or over-trading because of impatience or excitement. Another vital aspect of trading psychology is accepting losses. Every trader faces losses. It's part of the game. But instead of letting them derail you, learn from them. Ask yourself, what went wrong? What can I improve next time? This mindset shift from fear to learning is key to long-term success. Balancing the tactical and the mental. While money management tactics like risk-reward ratios, stop losses, and position sizing give you the technical foundation for trading, your mental game can make or break your results. The most successful traders don't just rely on strategies. They've mastered their emotions and maintain a calm, disciplined mindset under pressure. So what's the takeaway? To become a successful trader, you need a solid game plan that includes money management principles and a deep understanding of your psychology. Your ability to control risk, manage losses, and stay calm under pressure is just as important as picking the right trades. This book is a goldmine for traders, packed with powerful insights on reading charts, spotting trends, and making informed trading decisions. If you found this video helpful, don't forget to like the video, share it with your fellow traders, and subscribe to the channel for more trading strategies and market insights. Stay focused, stay disciplined, and I'll see you in the next one. Happy trading!